This is Radio Free Wall Street with Lee Adler on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street, produced Friday, May 16th and Saturday, May 17th. Today I'm going to do something a little different. I'm going to do some technical analysis. I'm going to go over a long-term chart of the S&P 500 that shows trends and cycles. It's a chart that I post every night in the Wall Street Examiner Professional Edition Market Update. Those of you that subscribe to that are very familiar with this, but I'm going to fill in some of the blanks and some of the detail that perhaps you've been wondering about. And it should give you some perspective on why the market's behaving the way it is and where it's likely to head next. This is a long-term cycle chart of the S&P 500. It also includes trends and a couple of indicators. It's just loaded with information. Let's take a look at some of it and analyze it, and maybe it'll help us get a better understanding of why the market's been behaving the way it has for the past several months, where it's likely to change in terms of time and price, and give us some idea of where it might be headed going forward. First, let's just start with some basic trend lines, something that everybody understands. We'll start from the low in 2009, connecting with the 2011 low, and just connect those 2 points and extend a trend line right through there. And you'll see that we're still a good ways off that line. Currently, it's at about 1725. Even that would not be a 10% correction from where we are now. So just to give you some perspective, let's draw a second trend line from the 2011 bottom through the 2012 bottom right there. Now, this trend line gives us a little better perspective on exactly why the market hasn't sold off much. This line starts at the 2011 low. It intersects the 2012 low, the double bottom here, somewhat higher low on the second low at the end of the year. And then we had a hot stove touch back here at the end of January. And we didn't get much momentum off there, and we touched again, and we're just sort of crawling up along this line. So one of two things is going to happen. We're either going to break down and head for this longer-term trend line in the mid-1700s, and that would require a break of approximately 1850. That's your critical support area. There's another trend line that comes off the 2011 top, and you can see it intersects this other long-term trend line right about now, this week, the week ending May 16th. So there are two long-term support lines that intersect right where my cursor is at about 1839. So 1850 to 1840 is a really hugely important critical support area. If you break that, then the chances are we're going to head for this trend line down here at 1750, have a pretty decent sized correction. Now, it could do that all at once in a very short sell-off, or it could meander sideways through here. We get a little dip down here and then bounce around and maybe not get too much below 1800. That round number there could be some support there as well. On the other side of things, on the upside, you have a trend line above connecting these two highs here at the end of last year and here in the middle of March. And that extends through approximately 1920 on the S&P. So that's a target area that I've had on my shorter term cycle projections. If we get up to 1920, maybe everybody's going to get all excited because we break 1900, but the chances are it's going to be a false breakout. We've had that broadening formation that I've shown on the daily charts. Let me just draw that in real quickly here. So anything between 1920 and 1720 really is a nothing burger in terms of changing anything regarding the long-term trend. So this is why these two lines up here are why the market is kind of stuck. You have very strong support, except for this one brief dip in February. There's been very strong support along this trend line extending from the 2011 high through the 2013 high. There were 3 touches of that. Okay, so it was strong resistance, and then when it broke out finally, tested here, it became strong support. Minor break here, came right back. Still having trouble breaking down through this support area here. So we're kind of stuck in this slightly uptrending trading range that goes back 6 months. And there you have it. That tight little trading range is where we're stuck. And until we break out, either breaking 1845 or so, 1840 on the downside, or breaking out through 1920 on the upside, we're not going anywhere. And it also emphasizes that a breakout through 1900, while it may excite everyone, isn't going to mean much in terms of the big picture. They got to get it through 1920 to get another up leg going. Otherwise, then maybe, this could develop into a top. Let's look at some of the time frames involved here. This chart shows the brown channel, which is the 10-12 month cycle. Let's call it the 1 year cycle. You can see it made a bottom here in 2011 and then another bottom here in at the end of 2012, but then it stopped cycling. It started trending. Here's the indicator for that cycle. There's momentum and a cycle oscillator. When they go flat like that in positive territory, that's an indication that the market is trending as opposed to cycling. Same thing with momentum. All these little whipsaws here are meaningless. We're just not getting any cycling out of this cycle. It's trending. So we go up to the next longer cycle, which is 2 to 3 years, and that's represented by this teal channel here. It bottomed in 2009, and then it had a price low here, but the cycle low is actually where it touches the long-term channel in here, around from early to mid 2012. It's about 3 years from low to low. So if we look at 3 years from high to high, the last high was in 2011, right around this time of year in May. So that would suggest a target for the next high, voila, right here in May, right now. So we look at the 3 year cycle indicators, the cycle oscillator and its momentum indicator. The momentum indicator is a little more sensitive and a little faster. You just have to be really careful about how you interpret it. So let's use a trend line again. Okay, so we take this trend line from the 2009 low, touching the 2012 low. This is the actual cycle low where the momentum made its bottom. Again, here in the middle of 2012, the end of 2012. There's your momentum low. And then the momentum takes off again, almost comes down and tests at the end of 2013. Has a little squiggle here. Looks like we're going to get a sell signal, but these are all kind of, momentum is going to do this. It's going to go back and forth across these signal lines. So we can't really take that seriously until we get a confirming price break at the same time. Now, look what's happened in the last couple of months. We've had another upturn in momentum where it's testing these highs here. There's a little trend line here. Let's draw that. As you can see, the momentum has turned up, but it has not quite broken this downtrend between these two peaks here. Now, if it does, if it breaks out through this trend line, and at the same time we get a concurrent move in prices through the 1920 area, that's going to suggest that this market can run for a while, perhaps up to the 2000 or 2050 area up here. On the other hand, if the 3 year cycle momentum stops at this trend line, and that becomes resistance, and then it rolls over and drops through this long-term trend line back to the 2009 low, breaking the positive trend in long-term momentum. And here you can see we have a nice long negative divergence here. That could be the sell signal that we're all looking for. That might be enough to turn me bearish, particularly if we take out this low in 2013. So again, we see these trends being squeezed together, this tight little trading range. No decision has been made. We don't know. I don't know which way this thing is going to break yet. Let's take a look at a little bit longer cycle. The 3 year cycle timing, again, Suggested top is in here, and the suggested low is in here. But if we don't get this top and we break out here, then we might be seeing a return to the 4-year cycle, and that wouldn't indicate a top until 2015 because the last top was back here in 2011. We haven't seen much evidence of the 4-year cycle lately, but there's no guarantees we won't know one way or the other until they get out of this trading range. Lastly, we have long-term cycle oscillator up here. This is the smooth line here. That's a very slow, more or less confirming indicator. It doesn't tell us much right now other than the market's been in an uptrend for a number of years. It's nothing we don't already know. Long-term momentum indicator is a little more sensitive. And again, if we draw a trend line from the 2009 low here through the 2011 low, you can see we're way above trend in momentum. So if we start with the 2011 low and draw a trend line from here through the next bottom, then we get a little different picture. Look at how these two lows create a trend line extended on a straight line to here. We touched it back in April and turned up sharply again, so that we're actually coming to the area where we made these two little highs in here. So this would be another confirming indication. If this line continues higher and again the market breaks through 1920, that would be an indication that we're in another up leg. So right on the cusp here, a slight break. I don't consider that material. We'll just have to keep an eye on that. And we're either going to come back down to the trend line here, and you can see it's triangulating, and the area of indecision is getting smaller and smaller. It's either going to break out on the upside eventually, break out on the downside, or it could trickle sideways for, I don't know, another 3, 4, 5, 6 months. That would be horrible, but that's the way it works sometimes in the market. So there you have it. This is the trading range we're working in. You can now maybe get an understanding of why things have been so tight along here. You have all these forces that have come together. The upside momentum has run out of gas, but there's not a lot of selling pressure to push things down through these rising support lines. So over the next, say, let's see, we're now in the middle of May. Between then and here, which is about the end of July, I think we've got to have a decision by that point. It's not likely that we're just going to go into the apex of that triangle and then trickle along this line for very long. We're either going to get a breakout and another up leg, or we're going to get a breakdown and a decent-sized correction down to this trend line here in the 1800 to 1750 area if it happens quickly, 1800 area if it's slow. If it's really slow, we might only get down to 1850. At that point, we have another decision point. The chances are the market will not break this trend line on the first try. If we come down to this trend line, we've only had one prior touch. That's in 2011. It's very rare that a market's going to break a trend line on the second touch that's been in force for that long. And even the third touch is a 50-50 chance of a break. It normally happens sometimes later, 3 or 4 or 5 touches down the line, and each succeeding reaction off of that trend line, each succeeding rally gets weaker and shorter in terms of duration, and then at that point you get a breakdown. So it's a similar situation to what we've seen on this trend line from the 2011 low. We had a touch here. Well, that actually created the trend line, and then we had a second touch in January of this year. We touched again in April. We've been kind of trundling along the line here. So this would be a good chance for a breakdown. It's not guaranteed, but if it does break, then from here, I think we get a pretty significant reaction rather than a continuing breakdown. So that's how I see the long-term picture. I hope that this chart, this long-term perspective, has given you a sense of what's going on in this market and some understanding of this narrow, frustrating trading range. But the good news is that the chances are sometime this summer, sometime between now and the end of July, we're going to get a resolution of this thing. And one way or the other, we're going to be able to trade it. Right now, I don't know which way it's going to go. I will say that there are some long-term cycle projections that point to 2100, 2125 area. They're not carved in stone. I don't know how much weight you would give that, but it's certainly something to think about before we turn outright bearish. And I'm not going to do that until, as a first step, we see these trend lines broken. So there's the technical analysis. Now, technical analysis in itself can be helpful, but it's more helpful if you have context. And by context, I mean liquidity, in particular the central bank-driven liquidity that I track virtually every day. And I report on that in the Wall Street Examiner Professional Edition Fed and Treasury reports, and I know that most of you subscribe to those. Now, we discussed in the last podcast that withholding taxes have been in a downtrend for about 6 weeks, and that continued this week. And Treasury supply has begun to increase as a result. Nobody's mentioned that. Nobody's noticed it yet. If the Fed does not pause QE and Treasury supply does begin a gradual increase, that's going to shift the supply-demand balance to the bearish side. For now, if the Fed is watching this situation and they see an uptick in Treasury supply and a slowing economy, and they decide to pause QE going forward, then there's still going to be plenty of excess liquidity around to continue the bullish bias for stocks. So in that case, the bias for the technical analysis would continue to be with the trend to the upside. So we'll keep an eye on those forces in the days and weeks ahead as they develop. Now, these videos, I've enjoyed doing them, but they do take me several times longer to produce than the audio podcasts. I'm going to continue with these videos, but I will not adhere to a 2-a-week schedule. I'm going to cut back to 1 a week. I'll do a second video if time permits and if conditions require. But I think in the videos I'm able to convey a lot more information by showing you as well as telling you. So I'm going to cut back to 1 a week. They might be a little longer than normal, and I hope you continue to find them useful and you continue to enjoy them. Again, use the feedback forms to let me know what your thoughts are as we develop this process. So I thank you for your support, and we'll get together again next week at some point. I will post the schedule at radiofreewallstreet.fm and wallstreetexaminer.com. So until the next time, have a great couple days. Enjoy the rest of the weekend. Trade sane, and we'll see you next week. This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.